If you're thinking about investing in PayPal or you already invested, then this is a video you can't afford to miss. There is a huge possibility that Warren Buffett might invest in PayPal based on data. But before I show you why Warren Buffett might invest in PayPal, let me talk about what happened to PayPal in the previous 2 years. We all know that the company is down 80% from its all-time high. It's a great opportunity to invest in a fintech giant. At the same time, Warren Buffett and his team at Berkshire Hathaway have withdrawn $152 billion from stocks and ready to reinvest. Not only that, but also Berkshire has always loved financial companies and owns shares in many fintechs. Looking at the stocks now got me wondering, what might Berkshire be buying shares in? In order to know, we need to look at what fits Berkshire or Buffett's criteria, because we all know that Warren Buffett only invests on companies that meet the 4 rules he always talked about. First rule is consistency. As Buffett mentioned many times that he invests in a company that will stay in the next 10 years, and he gave example of Coca-Cola. You don't want a company that suddenly disappears and you lose all your money. PayPal is one of the leading fintech companies and its possibility of staying in the market is high. The second rule is net income should be increasing. In PayPal's case, the net income is not increasing. However, the revenue is. The third rule is gross margin should be more than 40%, and yes, PayPal has over 40% gross margin. The fourth rule is cash flow must be positive after deducting the long-term debt and capex. Yes, PayPal's cash flow is positive after all deductions, which means the company is far from filing bankruptcy. PayPal ticks all Warren Buffett's investment boxes, which makes it a high potential investment for Berkshire Hathaway. Also, Warren Buffett is known for buying cheap, and PayPal is almost too cheap to ignore. That rare combination of cheap stock that is generating revenue and well-known consistent company and fitting Warren Buffett's investment industry is making PayPal on the radar of Berkshire Hathaway. But there is a small twist. Giant companies like Google and Apple and even big banks started to join the fintech industry by making an online payment platform, which might put PayPal in risk of bankruptcy. The only way for a successful company to lose is when a giant competitors enter your market. Here is a short video of Moon explaining how PayPal lost its monopoly to tech giants, which resulted its 80% collapse.
At the exact same time, PayPal's business model was beginning to fall apart. You see, with their incredible growth during the pandemic, it seemed like their monopoly plans were working, but instead of properly managing their growth, PayPal spread themselves way too thin, and today they are losing massive amounts of growth compensating for it. And that's why during the time that PayPal was partnering with the ADO, PayPal's monopoly plans were falling apart. By around the end of 2021, PayPal's revenue would begin to be cut by half, and with this came many more burgeoning alternatives. And worse still, Google, Amazon, and Apple have all released some versions of PayPal services, whether it be Apple Pay, Google Pay, or any of the other miscellany of services. And it's by using things like Apple Pay that these big companies have integrated their own payment transaction methods into the greater span of their company. And that's why Apple and Google make it a lot easier to use their services than PayPal on their smartphones. And for many years, PayPal was the only payment transaction method that these big companies relied on. But now it's becoming clear that PayPal is quickly losing their monopoly, and they really don't offer much else to the market. In fact, now it seems like PayPal is negatively affecting the market, and instead of being user-orientated, PayPal is now making their services less and less desirable for their users.
But regardless of all that, I think it is one that investors should consider. I'm not an expert stock analyst, but Cameron Stewart, the CFO of Orange Theory Fitness, has a CFA and is expert in the field. He made a 27 minutes analysis about PayPal and recommended buying the stock at the end of the video. I took few clips to summarize his analysis. First, he talked about how he is going to evaluate the stock. At the end of the video, he rated the stock.
PayPal stock is down 80% from its pandemic high. It's $60 a share right now. That $60 is actually cheaper than it was 2, 3, 4 years ago. So let's dust off the one pager, figure out how much cash money this stock makes, and if we apply a conservative forecast going forward, do we think it's going to beat the market? You ready? Let's get to work. Okay. So this is PayPal. Let's review the 5 key attributes here for this stock. Number 1, top line revenue growth. It's growing. Check the box. Number 2, EBITDA, enterprise level value, earnings are growing. Number 3, strong free cash flow. Yes, check it. Number 4, low debt. Number 5, well priced. Yes, I think those are all check boxes. It's a well priced stock because it's yielding, or it's estimated to have an 18% IRR, which beats the S&P 500. So I'm going to give it a good. I also want to call some attention to the fact that this stock, at its current price, is a trifecta.
After watching this whole video, now you'll ask me, how can I make my own analysis? Well, I'm gonna guide you on how. I made an analysis on how Warren Buffett picks a stock with 5 simple rules explained in only 1 minute. You can watch this video right here, and based on that you can make your own decision.